Good evening, everyone. My name is Scott Grant. I'm a director of London South East. You know us better, I'm sure, as lse.co.uk, which is one of the leading private investor portals or websites in the UK, so hopefully cater for all your needs. A warm welcome to this event. This is our first investor event of 2019. A common thread over the probably 10 or so events we've actually curated for you over the last year or so is the wonderful companies that we've had come and present. Of note tonight, you've got Jadestone Energy. I think they have the largest market capitalisation of any company that's been at one of these events, and it's pushing, I believe, £200 million currently. Also, Tower Resources, Jeremy, the CEO, was interviewed by us, if you look at our YouTube channel, last November, and Jeremy's interview got nearly 3,500 views, a very substantial engagement from you guys. And finally, InfraStrata. Looking at InfraStrata on our website today, looking at some stats, just for February alone, InfraStrata had 132,000 pages of data for them and chat and so on and so forth looked at. So these are companies that on lse.co.uk people are highly engaged with, and we're very grateful to have them here tonight. Anyway, I hope you get everything you need out tonight, some good information, some good investment cases, and have fun. Stay behind afterwards, please, for a bite to eat and a drink. One last thing, I've been asked to mention by City Index, our benevolent sponsor for the evening. There's umbrellas outside. There's probably about 10 or so. So if it is raining when you leave, feel free to take a free City Index umbrella. Thanks a lot.
Thank you very much indeed, Scott, and a very good evening to you all. Those of you who've braved the weather and decided you really can't watch the latest Brexit developments, and we're going to focus on, I think, what's really one of the favourite sectors for supporters of London South East on the chat boards and around the place. Oil and gas has always been of great interest, and I should also welcome people if they're watching at home. We are going to record and rebroadcast this event in 24 hours' time as a broadcast quality transmission. So if you are here with somebody you shouldn't be, you have been warned. You just could be on camera. A little bit of housekeeping, emergency exits. There are stairs at both ends of the building, so in the highly unlikely event of the fire alarm going off, if you make your way out and down, and generally speaking, the idea is to meet up just on this side of the square. So if you could bear that in mind. If you could bear to do so, please switch off your phones, because the signals on those are prone to interfere with our radio mics, and that may spoil the sound of our programme this evening. We hope you're going to ask questions of all our guests. If you do have a question, just in the usual way, just raise your hand. We'll bring the microphone to you quickly so that everybody, whether we're in the hall or at home, will actually be able to hear the question you're asking. And Scott's already mentioned refreshments. We hope you'll join us for those afterwards. There'll be the opportunity to speak to any of our guests one-to-one if there are particular things you want to raise with them they've not covered in their presentation, things that concern you as an investor. This is the opportunity, and also London South East people, Scott and others, will be available for you to chat to outside, so do take that opportunity. Now, I know you don't want to hear very much from me. I will just mention one thing. I was looking at some comments by John Hess, who is the chief of Hess Corporation, of course, a very large oil company, and he said that oil and natural gas are likely to remain a major part of the global energy mix for at least 15 years. And it's worth bearing that in mind, of course, with obviously the welcome rise in renewables. So we are still likely to need more energy resources than are currently around. The upstream industry needs to invest more, And here is an opportunity to get in on the ground to hear about some of the exciting plans that these companies have. Now, a little bit later, we have a great overview coming from Richard Slape. He's an independent consultant with 30 years' experience. Hopefully, he's going to share some of the tricks and thoughts he has had on investing in oil stocks. So we're looking forward to that. But let us kick off straight with our first company, which, as Scott mentioned, is Jadestone Energy. It's an upstream oil and gas company in the Asia-Pacific region. And we're very pleased to welcome Paul Blakeley, who is the President and Chief.
Thanks, Nigel. Thank you very much, Nigel, and good evening, ladies and gentlemen. We've been here for over a week now, the CFO, Dan Young, and myself, and our investor relations manager, marketing and presenting our guidance for 2019. It's the first time we've ever done a guidance, and so it's been a very interesting week. I think the reception has been strong, but as we've labored through the week in freezing cold weather, I have to say, I wasn't prepared for it. This evening, something unique has happened. Our stock in Toronto went up 7%. So obviously, despite the whole week in the market, it's being here this evening that obviously makes a difference. So thank you for whatever you did. Our origins as a business stem from a small exploration company called Mitra Energy, which was listed on the Toronto Exchange for several years, operating in the Asia region. The management very focused on exploration, and shareholders looking for cash flow decided a change was necessary and brought in myself and some of my colleagues who are ex-Talisman Energy. And for those of you know the North Sea sector well, or elsewhere in the upstream segment, Talisman Energy was an upstream E&P company that really focused on acquiring and exploiting producing and undeveloped assets. Not necessarily an explorer, but more an acquirer of second phase activity. And I spent 10 years in the North Sea building out the Talisman business, and we became a very significant operator here in the UK, and then moved to Asia to do the same thing. And in 2015, Talisman was acquired by Repsol, the Spanish company, and we decided that Asia still had lots of opportunities, and our strategy was sound, and although not quite unique, was not a common strategy in Asia, and we felt that we were well positioned to carry on, and so we were looking for a vehicle to keep going with an acquire and exploit strategy, and so we took on the Mitra platform, rebranded to Jadestone to get away from the exploration image, because I'm not an explorer and the team are not either. And our story is very much moving away from the idea that we want to invest in the significant geological risk associated with exploration, and also to spend the amount of time it takes to turn an exploration success into production and cash flow. I don't want to participate in a business that has that amount of time associated with monetization. And so rather than that, we've adopted really the Talisman philosophy, and in launching Jadestone in 2016, still listed on the Toronto Exchange, we went about acquiring some producing assets, an old oil field on the northwest shelf of Australia called Stag. We also acquired a small producing asset, actually Legacy Talisman in Indonesia, to build out the portfolio in Asia. and we have a legacy undeveloped gas development in Vietnam. So, you know, if you look on a very small globe, they all look pretty close together, but we do fly 7 hours from, you know, one end of the business to the other. To investors here, we say Asia Pacific. It's pretty simple, and, you know, trust us, it's all going to be fine. On the ground, each area does have differences, but we bring a sort of, you know, a common purpose wherever we are, which is looking to acquire assets where, you know, we can buy them cheap if possible, but more importantly, they have significant reinvestment opportunities. And so, you know, the value we create through the actions we take is where we differentiate ourselves from others. And there's no point just buying barrels. And so, you know, closing an asset deal is important, but it's what you do the day afterwards that actually makes a difference. And I'll give you a couple of examples. I'm not going to use the slides here. You've got copies in front of you, and I'm not going to talk to all the slides. What we've provided is I think, you know, some information that gives you a sense of how we go about the story. And so, you know, slide 4 in your pack, which actually is titled Right Team, Right Place, Right Time, really speaks to the principle that the Talisman experience, which is 20 years of doing this, we've acquired probably 30 or 40 producing fields over the piece. And at the end of our 10 years in the North Sea, for example, Talisman was the second largest operator in the North Sea behind only BP, producing about 170,000 BOEs a day. So it was a big business, but it was all done without the exploration drill bit through acquiring assets from the majors and others. The place we'll call Asia Pacific, and, you know, our perspective here is, broadly speaking, the Asian economies are still growing economies, and throughout the cycles over the last 10 years, we still see Asia as being at the heart of global growth. We see in each country rising energy demand and a shortfall of energy supply. So pricing is strong, which is a pretty important part of the equation, both for gas for local consumption, but also liquids, which sell generally at premiums. And so that, you know, is a first very important part of the story for us. The second part of the story is access to opportunity. And rather like the North Sea, for those of you who have, you know, followed the evolution of the North Sea and other maturing basins, what typically happens is that the majors are the new entrants. They take the largest risk and therefore generally the largest reward. Ultimately, though, their patience runs out, the opportunities become less material, and their investment thesis starts to move elsewhere. And that's when second phase operators come in, smaller companies, more nimble, quicker, simpler process, and with a focus on second phase activity. That was certainly Talisman's growth in the North Sea, and that's our view and what Jadestone is now doing in Asia Pacific. And so we have the team who's done this, you know, many times. You know, we're in an area where we see lots of opportunity, and Asia Pacific is now reaching that level of maturity like the North Sea was 20 years ago. And so we think it's a great time, and we're starting to see the majors getting restless and delivering up assets. And our thesis was to create a company that could become a credible counterparty in transacting with the majors and taking on these kinds of assets. And so the timing, we feel, is absolutely right. And, you know, there's a lot of data from Woodmac and other sort of independent sources that confirm, you know, growing maturity in the basins in Asia, less investment from the majors, more assets coming to the market. So we feel we're perfectly placed. And so as I've outlined, and we have some details on slide 8 in the presentation, when we talk about our strategy, it is absolutely to take on assets which have a lot more investment potential beyond what we see on day one. And so what we're looking for is multiple levers of reinvestment option. For example, we want to see an ability to reduce operating costs, perhaps improve uptime performance on the asset, drill infill wells and change the recovery factor, but other things too. There's often commercial opportunity. There may be little exploration, and we call that little E as opposed to big E. And little E is low risk and follows on from production and captures the near field small remaining potential. And then there may be an ability for the infrastructure to capture third-party streams as well. And so when we see assets that carry all of those opportunities, that's perfect for our strategy. On slide 9, we talk about the portfolio that we've started to build out as Jadestone. It started with the acquisition of the small Stag field offshore West Australia, as I touched on, but also in Ogang Komering in Sumatra, Indonesia, and then finally as a legacy asset, the undeveloped gas discoveries in Vietnam. And then earlier last year, looking to grow the business and to grow materiality, we looked at a new field in Australia called Montara. Now, Montara produced at around 8,000 barrels a day. It was being sold by the Thai National Oil Company, PTTEP, who've had an unsuccessful operation there. And in that lack of success, we saw huge opportunity for us. And so we settled a deal in the summer and closed late September with the Montara field, and we're going through the typical process of transfer of operatorship right now. But Montara is the classic asset for us. It has lots of low-hanging fruit, lots of things we can do. We're already taking costs out. We're planning to drill our first infill well and numerous well interventions that we'll carry out with a program during the next quarter. There are other great features to Montara that may be hidden from others' view of the asset. It comes with huge tax pools, and so it makes it probably the lowest taxed upstream opportunity in the whole of Southeast Asia, because it carries $3 billion of unutilized tax, and so will only ever pay a corporate tax of 30%. Whereas ordinarily assets will capture other taxes, petroleum taxes and so on. So that makes all of our investments even more valuable, given that profits, we retain 70% of all the upside. In acquiring Montara, we took the opportunity to move to London, and we listed on the AIM exchange in August of last year. Through an equity raise of $110 million solely for the purpose of funding the acquisition. We had great support from our banks. The raise was oversubscribed, and we were delighted with the outcome. And in doing so, picked up some great new investors and broadened the shareholder base significantly. And investors in our stock today, from that raise are companies like Miton, Fidelity, Bailey Gifford, and many others whose names I can't remember. The stock's well held, but we certainly want to support the idea of retail investors playing in the stock too, and hence why we're delighted to come and talk in forum like this to broaden the story and to widen the understanding about Jadestone. And so on slide 10, we describe Montara. I'm not going to go into any details. I've sort of touched on it. It consists of an FPSO that we own as part of the acquisition, a small platform with wells and some subsea wells, and all of that creates lots of opportunity and cost reduction and further activity. And then on slide 12, we provide you a description of the Stag oil field. It's relatively small, but has a lot of barrels. It's a low energy reservoir, and so it comes out of the ground slowly, only produces at around 3,000 barrels a day, but it's free cash flow positive, and it will deliver barrels probably for the next 15 years or so. So in that sense, it's a great underlying asset to the business, pays all the bills and more, and we're delighted to have it. It was also useful because it allowed us to present our credentials as an operator. In Australia, the regulator is tough. It's a regime that's like the North Sea, and to be credited as an offshore operator really helps us to chase other assets, and in fact was probably pivotal in succeeding to acquire Montara subsequently. So having those credentials, demonstrating you've got the capability and the process and so on in place was an important part of the Stag asset. And then on slide 13, we talk about the Southwest Vietnam gas development. As I say, this was the one thing that was in the legacy Mitra platform that we backed into, that we kept. It's well known to us at Talisman, ex-Talisman, because it's adjacent to a very large Talisman producing asset just to the south. The interesting thing about this gas, there's over half a TCF of discovered resource, but we can move very quickly to develop about 200 BCF into a nearby existing pipeline infrastructure that feeds a power station in southern Vietnam. And so the development is moving along on track. We're in a pre-feed, and we hope to sanction the project later this year. It adds material growth in production, cash flow, and value, and so far it's on track. And whilst I can tell you, in some of the countries that we operate in across Asia, whilst there's often uncertainties with respect to government approvals and processes, which are sometimes quite opaque, in the case of this development, it's going to feed an existing power station that is moving short of gas. The supply today is in decline, and so we'll backfill, and it means we're seeing really strong support from the Vietnamese government to get this project on stream. And so that gives us a lot of encouragement in both the commercial terms that will be struck and their support to the development as a whole. So in that sense, this is, and we have a long history, I have to tell you, in Talisman of operating in Vietnam, but this feels like the most comfortable and open process I've ever experienced there. On slide 14 in your deck, we provide what we've been showing the market for the past week, which is our guidance for the year. Last year, Jadestone was producing around 3,500 to 4,500 barrels a day. This coming year, we're saying 13,500 to 15,500. So it's a material change to our business, and that's thanks to Montara. But the other thing about our guidance is, for the first time, we're delivering a significant capital program on top of the acquisition. We'll be drilling the first well at the Stag field for over 6 years. I mean, we've operated it only for the last year and a half, but it'll be the first well for 6 years, and we're excited about that. The rig's moving now. Should add 1,000 barrels a day and change the whole cost profile of Stag. So that's an exciting step forward for the Stag field. A lot of the capital is on Montara. We plan a well towards the end of the year, and that well should come on stream at around 3,000 barrels, which is great for 2020. But in 2019, we've got interventions into existing wells, installation of gas lift, and a variety of other things that, again, is designed to lift production by about 3,000 barrels a day. So there's a lot going on. And the final thing for the year is we'll shoot a new seismic survey across the Montara license, because we do see a lot more potential there. And so overall, the guidance, if you were to take our average operating cost of $21 to $24 a barrel, think about an oil price today of around $65 a barrel. Include all of the what we'll call the major spend, mostly capital, of around 120, and set against the production volumes, we'll be able to carry out all of this capital activity, and we'll still have around $100 million of free cash left. And so, it's amazing how quick in acquiring, producing, cash flowing assets, the flywheel of cash flow generation really spins up fast. And with Montara, we've really accelerated the cash generation story. And whilst we took out a reserve-based loan in support of Montara as well, we'll materially pay that down this year, and still have free cash left. And so looking forward into 2021, we can develop the Vietnam assets all within our existing cash flow, deliver growth to 30,000 barrels a day without having to come back to the market. So far the story is working really well. There's a lot of hard work goes into operating mature assets, I have to say. There's a lot of skills that are required, and we pull quite a bit of that experience from the North Sea, and a lot of the people that are involved in the asset have been doing this for 20 or more years, and that's pretty important. Having delivered so far to the story, and we're able to speak this week to investors and say, remember what we told you last summer? Well, it's still the same, which is a relief. Nonetheless, if you turn to slide 16, Jadestone remains a very compelling investment because the market recognition is definitely not there yet. And so what we show is a 2p value that is more than twice our current trading value. And that excludes even the development in Vietnam. And so the conclusion that we've come to is, with a new kid on the block on the AIM exchange, we need to prove that Montara cash flows are real. When we acquired the asset last summer, for about 70% of the 1p reserves, the market was suspicious. This is too good to be true. And so we have to show the market, I think, over the next couple of quarters that is not the case. And production recently has, I think, already started to signal that the asset is high quality. And with progress towards the development in Vietnam, we're hoping the recognition from the market will come over the course of 2019. If not, we'll just have to buy our shares back. But, as an alternative, we'd be more than happy if you were to buy the shares instead. So, I think we're on the right track. I think we've set ourselves up well for the future. We're waiting for Shell and Exxon and Chevron and so on to start bringing assets to the market, just like they're doing in the North Sea. And we're positioned to take full advantage of that. So with that,
thank you very much, Paul.
much, everybody, and happy to take questions.
Well, that was a round of applause. That was exactly your allotted time of 20 minutes. So here's a man who meets his deadlines,
excellent.
Which is excellent. Who's got a question for Paul? We've got one right at the front here. Just bring the mic over.
This is a brief question to Paul. My name is Mark from Genesis Oil.
Okay.
Coming from a chemical engineering background, I think you made a point about one of the assets that you took over from the was it the Vietnam? I think it was the government that relinquished that particular field, or because they weren't having much.
Montara, you're talking about?
Yes.
Okay.
So what sort of gave you that confidence that you would take it over by using a different approach to sort of because coming from obviously because we sort of deal with assets where depending on how you drill and also the orientation you take, you can recover a certain amount of volume where say another operator would not have actually acquired that. So I just wanted to know what sort of approach or confidence that you sort of took that made you go for that, where they did not want to proceed.
Okay. So a question around, you know, how you know, why are we confident that we can take a different path to others?
Use the microphone.
Sorry, sorry, beg your pardon. So the question around what, you know, why we have confidence to take a different path than the others, previous operators, and so on, in the way we take an asset forward. I mean, the first thing I would say is you know, one reason is because we have a lot of experience of doing it. I mean, you know, Jadestone is a very young company, and our portfolio is still quite small. But if but the team, and I think there is a slide in here. You know, it's the management team is Talisman Energy, and we've been doing this for 20 years. You know, don't ask me to drill an exploration well or develop an LNG terminal, or we stick to our knitting. We're good at a very niche skill set, which is taking assets from majors and from others and transforming them, and that's all we've done for a very long time. And so for that reason, we have a lot of confidence. No two assets are the same, and so you have to take a completely fresh approach when you look at an opportunity. Whilst it's interesting to look at the seller's view of his own asset, my experience is, it's not a good data point. It's a fixed view that may have been held for years. It stopped, challenging the way an asset could be, developed differently. And so from the bottom up, we build our own view about the potential.
But you can understand investors' skepticism because in many cases these are major companies and they have decided this isn't working. So they're wanting to get rid of it. I mean, if it was so great, why would they be making the asset available?
Good. Thank you, Nigel. Let's cut right to it. So in 1995, Talisman started in the North Sea as a venture, as a second phase operator, and we acquired the Beatrice, Buchan and Clyde fields from BP. Tired assets that had, on average, a remaining life of 2 years. The Beatrice field was looking forward to 12 months more production before cessation of production and abandonment. Buchan was 4 years, and I can't remember. But so on average, it was 2 to 3 years between the three fields. 20 years later, all three fields were still in production. And it's not because BP can't do it, it's because they're not interested in doing it. And the whole point about BP is, and this is a really interesting specific example, and there are many others, but the point about these three assets is BP even recognized in their maturity that they had to operate them differently. They hived them off into a separate group called the MAST assets, the Mature Assets Team, and they set them up outside of the main BP hierarchy. They even put them in a little dirty old Nissan hut at the back of the main BP terminal office to signal, we're different, we're low cost. And they removed all of the corporate overhead, BP overhead, and they said, we're going to do a great job here. And they took 30% operating costs out of the assets in doing this and felt that it achieved a great outcome. We took them on, and 12 months later, we took another 30% out of their operating costs because we just don't have those processes. You have to be far simpler, cleaner. You need to do the important things, but there's a whole lot that corporations do that absolutely add no value, and that's just how it is. But the most important thing that made the difference was capital investment. And if you don't invest in the assets, you don't really change very much. Taking another 30% operating costs might have eked out another couple of years of production, but you have to invest. And the problem with the MAST assets in BP is They still had to go back to the mothership and compete for capital, and these assets and the opportunities are small. And in BP's scale of activity, they just didn't compete for capital. And so that's why it's not, you know, it's not because BP, well, it is actually because BP can't. I mean, you know, they're just not set up. Large companies are not set up to do small things.
Anyway,
so
great question. Thanks very much indeed for that question. Who else? Yes, one just in the row behind.
Thank you, Paul, for great presentation. My name is Dmitry, and you mentioned that market is not there yet in terms of recognition of true value of the company, and if market doesn't start recognizing this year, you'll do share buyback. What are the major factors why you think market is not recognizing? Is it geography, because it's too far and there are no peers which create the story? And what is your plan, how you are going to address those misunderstanding of the market and to eliminate this discount which currently obviously exists from what you've presented? Thank you.
Thank you. You and I need to chat because I think you've got all the answers.
No, he's got the questions.
Because you're right. I mean, you know, the recognition, in part, we are a long way away. That's true. In part because, you know, on the AIM exchange and in the small cap E&P space, there are a lot of names that are working in Africa, North Africa, West Africa. There are a lot of names that are working in South America, and there are a lot of companies that are in East Europe and so on. There are very few in Asia. So you know, the story about the opportunity, the regional opportunity, the big opportunity, isn't heard very often here, I think, and we need to do more of that. And, you know, whilst we'll welcome some competition, not too much, please. So that's for sure a factor. But as I said earlier, you know, for me, primarily it's because we're new. And whilst, you know, individually, personally, we may have a track record, the company doesn't, and we need to. And so I think the market is waiting to see, you know, Montara performance over the next couple of quarters and us delivering a gas project in Vietnam.
One more quick question from anybody? Yes, over there.
Thanks. Hello again.
Hi.
Your Montara well coming up later in the year. What kind of chance of success have you got on that working out as you hope? And I've got another one. Any lifespan on Montara? You said Stag's about 15 years.
Okay, thanks. So the infill well, it's the first infill well that we'll have drilled on Montara. We've selected the easiest location, the most obvious location. It's within, you know, I mean, the seismic's very clear and clean on the main field. We run reservoir simulation, and you can see quite clearly reserves that will be left behind. So, you know, the chance of success is very, very high. There's very little to no geological risk. There is well control around it. And we use data extensively to understand it. And, you know, the advantage of buying a producing asset is there's lots of data. And so we use that extensively. And I have very high expectations. And it's never 100%, but it's pretty close to being a certainty. In terms of field life on Montara, we project on our 2P reserves around 2031, 32. We have already identified some infill locations that are not part of our 2P reserves, so maybe 2035. And actually, we have a lot of gas, and we have given no value to the gas. Actually, the Montara field is an oil rim under a very large gas cap. There's no gas infrastructure in the area. We assume no value. A couple of weeks ago, Shell announced the development of a nearby gas field called Crux, and they're looking for gas into their infrastructure. I think this is great for us. It'll add value and extend field life further. Thank you.
Paul, thank you very much indeed. Okay, well, Paul's staying with us. You'll be able to chat to him later. Hopefully, I'll be able to take part in our panel discussion as we go along. But let us move now to another company which is on oil traders' radar. This is Tower Resources. It's an oil and gas company with a pan-African regional focus, preparing to drill in the Thali block in shallow water in offshore Cameroon. And we have Jeremy Asher. He is the chairman and CEO. He's got very broad experience of the industry, from being deputy chairman of the fully listed Gulf keystone to years as a management consultant and running global oil products trading at Glencore. So these are top companies. So let us hear from him.
Thanks very much. I just use the page up and down buttons, do I? Yes. There we are. Good man. So, as Nigel said, Tower is an oil and gas company with a focus on sub-Saharan Africa, and we have a history as an exploration company, which is why we still have some exploration licenses, notably in Namibia and in South Africa. But our main focus at the moment is in Cameroon, where we have an asset which is in development, which we're aiming to bring into production in the next 12 months. So that's our main focus, and that's also going to be what I'm going to talk about the most in the next 15-20 minutes. The license that we have in Cameroon, it's called the Thali license, is actually an exploration license because there's a lot on it still to explore, as I'll explain to you. Nevertheless, it has an existing discovery on it, and that discovery already has 18 million barrels approximately in contingent resources, with as much again in prospective resources just on that structure alone. Right now, as part of the process of exploring the block, we're also simultaneously going to develop that asset, bring it into production, and we want to do that as quickly as we can. To give you an idea of the scale of the prize, well, you probably already have a good idea because you're all seasoned investors of the value of contingent resources, but the EMV10, according to the reserve report of the contingent resources we have, is order of magnitude $118 million, which is in accordance with the kind of metrics you'd expect for contingent resources, with a similar amount, again, potential value in the prospective resources. In other words, it's something of value that we're aiming at, and right now, that's the most important thing for us, with the exploration aspects of the block, which are also very significant, but really pure upside. So, having said that, let me show you where the Thali block is. For those of you who are not so familiar with Cameroon, Cameroon sits kind of at the corner of the Gulf of Guinea, with Nigeria as its big brother to one side and Equatorial Guinea to the south. So it's a very petroliferous zone. There's a huge amount of production, obviously, in Nigeria, also now Equatorial Guinea is quite an oil province. Cameroon's been producing oil for years, but lately the production in Cameroon has been declining, as it has in many places because of a relative underinvestment. To put that in perspective, Cameroon produced over 100,000 barrels a day until quite recently. Right now, production's down around 70,000 barrels a day, most of that being produced by Addax and Perenco. The good thing about that is that there's a lot of infrastructure available. Not that we necessarily need it because we're offshore in the shallow water, and in the shallow offshore, actually, you can be pretty self-reliant if you want to. But you can see on this chart here the amount of the infrastructure operated by Perenco and Addax around us, all leading mainly to the Masongo terminal, which you can see in the bottom left. And the Masongo terminal is a floating FSO. They have two different grades of crude that they blend to and sell out of there. And we're quite close to all of that infrastructure. But at the same time, the infrastructure is also potentially going to grow further, because if you look at the right-hand side of the chart, you'll see the Dasoni North field, which is immediately to the north of our license, and that's not a coincidence. And then over to the east of that, you can see the Oak discovery, which Glencore made a few years ago and is now operated by Perenco as a joint venture between Perenco and Glencore. And that also is under development at the moment, and there'll be further pipeline extension over there. So our block is immediately to the south of Dasoni and quite close, as you can see, to all this infrastructure. The Thali structure, that we're most interested in is called Njonji. And that's the one that you can see towards the lower part of the structure, and I'll zoom in on this in a second. But you can also see from this map why we're very interested in the structures which are still undrilled in the northern part of the license, which are right next to the Dasoni North discovery, and also are very much on trend with oak. The history of the license is that originally it was a Total license, and well, in fact, even before that, it had been Pecton, Shell had it. But Total did most of the recent work on the license, and they drilled, at the time, the license included Dasoni North. It was all called the Dasoni license, and Total drilled 6 wells on the license. 2 of them were discoveries, discovering oil in this Njonji structure in this sort of southern area. And then they also made a shallow gas discovery, which is, to us, not particularly relevant. And they made 3 wells in the northern part of the license, which uncovered the Dasoni North field. But the whole thing was sort of tiny for Total, and Total made the decision around 2010 to disengage from Cameroon. They sold out to Perenco. Perenco took over this license, which at that time was the very end of an extended exploration period, and so they had to choose what to keep and develop and what to relinquish. So they chose Dasoni North, which was the simpler of the 2 structures, and they said, right, we're going to develop that. And they relinquished the rest of the license in around 2013. And that was how it was that we were able to acquire it in 2015. Now, the Njonji structure, Total knew that there was oil there. I mean, they tested while drilling, but they hadn't done flow tests to surface. And their original theory as to what was going on in the structure, which was based on quite old seismic, 3D seismic, but quite old data. It took a little bit of a bang when they drilled the second well, Njonji 2, also finding oil in the same reservoirs, but also establishing clearly that there was a sealing fault separating those 2 parts of the structure. And it made it difficult for them to be sure of what else was going on inside the structure. What we did when we took over the license, the original plan had been to acquire new 3D, but that rapidly proved to be impractical with the problems that the industry was having in 15, 16, because we'd originally been planning to do that work together with other work done by other operators around us, and there were vessels around. All of a sudden, no one was doing anything, and there were no vessels. So we agreed with the Cameroon government that we would instead reprocess the existing 3D, which, as I said, is quite old vintage. So we expected and received a very significant uplift in the quality of that old 3D, and then figure out what to do next based on that. We got that information last year, and what it told us was quite interesting. We could see clearly the sealing fault. We could also see another baffle-type fault, which sealed at the level of the lower reservoirs, because they're stacked reservoirs here, but not at the level of the upper reservoirs. And that's why, if you are looking closely at the picture, you'll see the sort of green blob on top of a sort of a red blob. And the reason is literally because the upper reservoir, we already know, extends across the whole structure, and that's why we've got 18 million barrels of contingent resources. But in the same structure underneath the lower reservoir, we know it's there in the upper part of the structure, the northern part, but we don't know whether the southern part of it, which is considerably larger, is actually oil-bearing. So that's why we have another 18 million barrels. These are all P-mean resource numbers. Could be more, could be less. But there's another 18 million barrels potentially in the lower reservoirs in the southern part of the structure. The only way to find out how much oil is there is to drill. So that's what we're planning to do. And that's why the well that we're drilling is called Njonji 3, because there's already 2 wells already drilled on the structure. But in fact, from our point of view, it's the first potential production well, but it's a bit of all 3 things. It's an appraisal well and an exploration well as well, because we haven't got really good flow data at all. Total never did a flow test. And what's more, we also think now, seeing what we now see, that the reservoirs thicken to the south, and there may be some things already a little bit further south in the structure, which may also be potential reservoirs as we sort of move a few hundred meters down to the south. So the work plan that we're actually undertaking is, first of all, we're going to drill the first well, and then we're going to take a pause. The first well is being planned both with the exploration objectives in mind, but also as a producer. We'll then mobilize and install a MOPU. We're choosing a well location that we think is not just a good well location as a producer in this section of the structure, but also as a good point from which to drill further deviated wells around a simple structure, so that we can put as many as 4 or 5 or more wells from this one location into different parts, both of the northern part of the reservoir where we already know what we've got, and also to test into the deeper parts of the southern part of the structures where, as I've said, we don't know if the reservoirs there are oil-bearing and have the same oil-water contact and so forth. So the idea is to do all of that without having to make further investment in costly infrastructure under the water on the surface. We're in fairly shallow water here. It's only about 30 meters. Costs are generally pretty low. Even so, the moment you start mobilizing vessels to do pipeline work, you immediately incur a lot of fixed costs, and therefore it's something that we don't want to do until we really have a good need to do it, and then we'll do all the pipeline stuff that we want to do. Until then, we're trying to minimize the amount of work on the subsurface and put ourselves into a position where we can have several wells producing into a MOPU and have a significant production operation without having to make those surface investments. Now, the amount of production we can expect from each well, this is one of the key things that we're going to determine with this first well. The typical flow rates for wells in the Rio del Rey in Cameroon range from 1,500 barrels a day up to about 3,000 barrels a day. But it's really very hard to tell what we're going to find because, first of all, most wells in this area are accessing multiple reservoirs anyway. Secondly, the specific reservoirs that we have in this particular structure are not the same as the ones in the Jadestone field immediately to the north, so we can't rely on that as an analog. I wish we could, because the Jadestone wells flowed over 3,000 barrels a day initial flow rate and have been performing well with, they've been using injection to sustain production since they started. We will have to see how these wells perform. So the way we're structuring what we're doing is as an extended well test while we continue to also conduct other exploration on the block. The beauty of doing that is that extended well test is still production by any other name, and we get our share of the production and the cost recovery just like we would if we were already in field development under the terms of the production sharing contract. However, by doing it while we're also still in the exploration phase of the license, it also means that we can continue to do other exploration work on the license, and the cost of that work is still part of the same single cost recovery pool. So that means that the risk of that further exploration work on the license is massively reduced. I mean, it's really almost nothing because the rate at which you recover costs is so fast on a project like this that effectively we'll be recovering the cost of any further exploration wells we drill in less than a year. The kind of mobile offshore production unit that we're planning to deploy is very standard in West Africa. In essence, the standard way to do it is you take a cold stack jack-up rig and you convert it. The jack-up rigs are available for a few $100,000, so it's a matter of taking it to a yard, buying skid-mounted process equipment, and putting it onto the platform. And then you use that platform as a production platform, and that's exactly what Perenco did just to the north of us in Dessoni, and it's done throughout West Africa. So this is a relatively straightforward operation and not hugely expensive. Having said not hugely expensive, there's no such thing as cheap in our business, so it's all very relative, and I'll talk about those costs in a minute. If this is successful, and in particular if the well into the southern part of the Njonji structure is successful, then that would just be the end of phase one. We'd then do a second phase, probably around a second hub in the southern part of the structure, and drill several more wells. But our hope is to get to 8,000 barrels a day of production off of the first phase, and then go from there potentially to 16,000 barrels a day or more, and probably all just using the one MOPU. The prize is substantial. The best estimate MPV-10 of the contingent resources, those 18 million or so barrels, is actually 158 million. The EMV-10 of 118 is based on a complicated formula which I'm not sure is particularly relevant. The key thing, though, is that those numbers all take into account the cost of development. So the point is you put the money in for that phase one of development, and just the phase one alone will then be worth what you put in, which Oilfield International estimate as being close to 80 million, and then if all's gone to plan, you have $240 million of value on the other side. So the net present value is about 158 million, but that means that the sort of ratio of what goes in to what comes out is very attractive, and the potential value of what we'll have once we've undertaken that phase one of development should be very attractive. And then there's potentially as much, again, in the prospective resources in the southern part of the license. And as I mentioned, there's also a lot of prospectivity in the north, but with the limited time we have, I'm not even going to dwell on that. Now, the real question is, how do we finance the phase one of the development? If you look at the cash flow impact in the reserve report, and we're using that not because we think that's our own personal base case of what's happening, but simply because it's in the public domain and it's an independent view of the economics of the project. Oilfield International estimated it'll cost us $78 million to do this. I think those numbers are a bit high. The key assumptions underneath that are $20 million for the first well we're drilling now, including testing, and $15 million for the subsequent wells. And then he's got an amount in there for platform and other infrastructure. The actual AFE on the well we're drilling now is a little under $15 million. And of that, the dry hole cost, what we'd expect to be paying for the subsequent wells is close to $10 million. This first well is costing quite a lot more because we plan to do a fairly extensive testing program on it, which we won't be needing to do on the subsequent wells. So I do think that the number that we're actually going to need to finance in order to bring 4 wells into production with a MOPU is going to be rather less than $78 million, but still probably $50 million plus. So the big question that most investors have is, well, how are you going to finance that? Because your market cap at the moment is less than $10 million. And the short answer is we do believe debt financing should be available. When you look at the cash flow that's coming out of these assets, and this is just phase one, this is assuming none of the prospective resources are there, just based on what we know is there. you're looking at $100 million plus a year. That allows you to amortize debt pretty fast. It allows you to service debt. It means that we should be a kind of no-brainer for reserve-based lending once we're in production. The trickier part is to get your financing pre-production, and that's what I'm working on at the moment and have been working on for the last 6 months. It's a more specialized market. It's not as easy as just walking up to one of the well-known group of reserve lending banks and asking for a reserve-based loan. So I understand why people worry as to whether or not we can do it, but I'm pretty confident that we can. That's what we're working on at the moment, and that's the main risk that investors face in the company. There's also the usual risks of nature and so forth, but this is the key to what we're about. We need to raise a bunch of money fairly shortly if we're to meet our schedule of getting into production by this time next year. But if we can do that, the prize is enormous, and the value of the company will be a whole order of magnitude different from where we are now. And it's really as simple as that. I'll talk just for a moment before I finish.
Just another minute or so.
Yes, about South Africa and Namibia. But South Africa is a license that we hold in joint venture with New Age. It's operated by New Age. There's 3 basins down there in the license. And the most interesting one at this moment is actually the Utinikwa Basin. Gamtoos and Algoa have been the basins that we've concentrated on in our work with New Age until now, because they're shallower basins, easier to develop if we had to do it on our own without a big partner. And we've done extensive 2D on one basin, 3D on the other, have drill-ready prospects, all very nice. But we were waiting on the prospect in the Utinikwa to see what happened with Total's Brulpada well. As many of you will know, Brulpada came in as a success, gas condensate discovery, about 1 billion barrels BOE, with more around it. Total are very excited about it. And we have a deep Albion Utinikwa Basin prospect that's similar, smaller, looks like about 360 million barrels, but obviously greatly de-risked by the success of the Brulpada well. So we've been waiting on that before deciding what to do next with the license, and now we've got a farm-out process underway. But obviously we're quite excited about it. We also have a long history in Namibia. We have a new petroleum agreement we've just signed covering blocks that we already know from years ago, and they're very good blocks, but this is pure exploration. I won't say a lot about it except to say, number one, that we do think we had an early choice of blocks, and we've got some of the best blocks in Namibia, we think. But also, the other thing is, because of the fact that we were first, we've already gone through a decade-long process of exploration, culminating in a well that we drilled mainly with Repsol's money, and Repsol operated it, which was not successful, but from which we learned something. But because we've done that, we're now back at the beginning of the process. So nothing more is really expected from us for a while, whereas other people who started later have still got well commitments, which is why there are going to be a number of wells drilled over the next couple of years. And before we do anything more right now than further desk work on the data that we already have, we'll have some other interesting data points from people around us, including Exxon, who've got wells to drill in the next year or two. So that will shape our work program there, but we have no liability there. We don't have a lot of money to spend. That's basically it. So the key point, I'm going to skip over the team, is Cameroon's what we're all about at the moment. We have our legacy, so we have South Africa and Namibia as well. What we've got in Cameroon is something quite valuable, 18 million barrels of mean contingent recoverable resources, something more than $100 million in potential value.
Thank you very much indeed, Jeremy. So, very different proposition to Jadestone. Clearly lots of things going on various fronts, but it all needs investment. So what are investors' thoughts on all this? Any questions?
Question at the front.
At the front here, yes.
This is a very quick question. In terms of sort of things like tie-ins, and do you have any sort of anything in place in terms of sort of to be able to tie in
to existing infrastructure?
Yes.
Yes.
To integrate, to sort of make it more efficient in terms of moving forward.
Well, the interesting thing about tying in, it's obvious that we're very close to the existing Perenco ADAX infrastructure. So it's obvious that in an ideal world, a relatively simple thing to do would be to tie into that. However, there are a couple of factors that we need to bear in mind. The first is to do so would imply a pipeline. And as I mentioned, one of the problems is that it's actually rather a short pipeline. So you might say, well, gee, I mean, that's going to be very cheap, isn't it? Yeah, but per kilometer, if that's the only pipeline you're doing, that looks quite expensive. So, and the second factor is, when you look at the prospective resources, which I didn't spend a lot of time on, but you know, those structures in the northern part of the license are potentially considerably bigger than Njonji. Now, are those, of course we're going to drill holes in those, assuming everything works as planned. And if those have oil in them, then of course at that point we'll have a more elaborate field development to consider, taking those into account. And that's the point at which we'd be planning the pipelines, because then we have an idea of what's got to go where. Now, until then, we don't really particularly want to get involved in pipelines. The second factor, anyway, is that even with the MOPU, without a pipeline into the existing infrastructure, we'll have a shuttle tanker, and we can go and shuttle the oil back and forth to the Mosongo terminal anyway. We'll probably want the shuttle tanker there anyway for storage. We can put some storage into the MOPU, into the legs, but we'll probably use the shuttle tanker anyway. So the shuttle tanker will be there. So the cost of taking it over to the Mosongo terminal is only fuel cost, which is not that great. And finally, using the Perenco infrastructure, of course, does require the agreement of Perenco. Now, Perenco have actually been very supportive to us so far, very friendly, helpful in terms of potential use of equipment and so on and so on. But, you know, they're not a charity, and obviously they'll look to get some economic rent from the infrastructure they've already built. So there may come a point where it makes sense to pay Perenco to use their infrastructure. It may be that we're better off just building our own pipeline. If we've got pipeline laying vessels there anyway, it may be better just to build our own infrastructure. We'll just have to see.
Can you just briefly compare and contrast? We heard the case from Jadestone previously, where they made it very clear that they're not interested in exploring. That's just not the model that works for them. But they're also, you know, still at the phase of trying to interest a wider range of investors. Do you accept your proposition in a way? It's different, but it's almost even more difficult, because you've also got to, people have got to take a lot more on trust, if you like.
Well, I think actually it's not that different. I think it's very complementary, but you know, the thing is that you start from where you are. Now, where we started was as an exploration company. Now, one of the conclusions we came to in 2013, 2014, when we were drilling a very high impact well with Repsol, was that we really needed to diversify the portfolio and what we were doing. And that was why we set about this whole process of building this business in Cameroon. And I won't bore you with all the details of why Cameroon, how we did it, and so on. But the whole idea was we wanted production. Now, lots of people wanted production, and they still do. But the problem is that if you just wander out there saying, oh, I want some production, so I'm going to pay top dollar for it. And remember, 2014 was top dollar. And if, in addition to that, you say, oh, and I'll borrow some money for it too, you know, you're really inviting disaster. The best way we felt to build production was to actually learn how to operate and do it and get our production with the drill bit. Now, that's a lot. All of these things are much easier said than done. So we had some knowledge of what was going on in Cameroon because of the people we had in the company and the people we were bringing in. We felt that that was a viable route, so that's what we set about doing. The fascinating thing about this license, which many people overlooked, was because it was called an exploration license, people ignored the fact that there was a discovery on it. And also we felt that Total had originally been very optimistic about this Njonji structure and then kind of got a sour taste in their mouth after Njonji 2 and didn't really, they sold it very shortly afterwards. So no one had really looked carefully at what had been done with it. But the whole point of what we've been trying to do is to build a production base. Ultimately, that's the point of the oil business. I mean, no point exploring if you never put anything into production. And cash flow is what we invest for. And I'm a big investor in Tower too, so I also had limited appetite for exploration as a source of amusement. You know, the idea is to get to production. And so we thought that's what we have to do. Now, it's a long-term project. We've been at this now in Cameroon since 2014, so nearly 5 years already. And it'll be another year or so before we get to production. But this is how you pay your dues, and this is how you build a business, which is what we're trying to do.
So, Paul, maybe you're not quite as different in some ways then.
I mean, if I look at the portfolio here, you know, I mean, what I see here is you know, low risk resource, close to infrastructure, proven hydrocarbon provinces, and shallow water, and therefore, you know, not too expensive to develop. So, you know, I mean, in many ways, if something like this was in Asia Pacific, we might even look at it. The exploration
move it.
Yeah. the exploration component, you know, in the other licenses we wouldn't. But I think the focus on this seems to be pretty sensible.
And the thing is, when you've got these relationships like we have in Namibia, I mean, a decade, there's something of value there, and you're very reluctant just to throw it away. But we're also very cold-eyed about it. We're not just going to take millions of dollars and throw them into Namibia because we have a past there. We're looking at that as an asset which we want to try to take advantage of. And it's the same thing in South Africa.
Well, thanks very much indeed. We're out of time there. That's Jeremy Asher, Chairman of Tower Resources. Thank you very much. And again, he'll be with us on our panel as we move on now to InfraStrata. Now, we've had one explorer, haven't we, and one company with a slightly different strategy, but both firmly in hydrocarbons, moving now to Arun, who is a director of InfraStrata, who are into storage, and they plan to excavate salt caverns already active in Ireland, or Northern Ireland, County Antrim, and, well, got some ambitious plans, so let's hear more about it.
Good evening, everybody. For all those who are expecting to see John Wood, our CEO, this evening, unfortunately, he is away on business out of the country, so he conveys his apologies to all of you, which also means you'll have to bear with me for the next 30 minutes. So who are we? We are InfraStrata PLC. We are listed on the AIM exchange. And we are in the business of constructing and commercializing an underground gas storage facility in Northern Ireland. We have a very simple corporate structure consisting of two main subsidiaries, both in Northern Ireland. Island McGee Energy Limited is the core subsidiary which is involved in the construction of the underground gas store. The Island McGee Energy Hub Limited is effectively an incubator for future projects. What is our vision? Our vision is to be a leading global energy infrastructure company. And how do we intend to do that? Our core expertise lies in the technical and commercial skills that our team has. We have embarked upon a strategy of taking on projects that are at their pre-FEED stage, developing it, going through FEED, taking it up to FID, at which point we invite our equity partners into the project, sell down a portion of the equity while retaining a portion of that equity. How do we make money? We make money out of three ways. Not as yet, but in due course. We will be handling the construction of the project and earning a fee out of the construction management contract. We are technical experts, we are commercial experts, and therefore we'll be operating these facilities. For the operations of that facility, we'll be charging a fee to the project company. And finally, because we retain an equity in every project, we shall be sharing in the dividends of each of those project companies. In order to achieve these objectives, clearly we need a few building blocks. We need a high-performing team, which we are currently in the process of putting together, both on the technical and on the commercial side. The evaluation process for evaluating, analyzing, and taking on new projects needs to be extremely robust, which effectively means that we are not taking any project off the street. We have a list of 30 to 40 criteria, which helps us to pick a project and then take it up to FID and thereafter. We surround ourselves with quality partners. Our partners within the current project are WSP, Atkins, Deep KBB, who do the subsurface work, and Costain, who do the above ground installations. So we are quite particular in picking up the best-in-class experts, surrounding ourselves with them to make sure we're doing the right thing. Clearly, the two building blocks for our business is operational excellence, but equally, we also need to provide sustainable growth. We need to provide value to our shareholders, and that is what the objective of this company is. This is a short video of our project. Rather than explaining the project over 3 hours, hopefully in 3 minutes, you will be able to grasp this project.
The Island McGee Gas Storage Project is an exciting project, bringing the energy needs to the local community and also supporting the energy needs of Northern Ireland and beyond. The Island McGee Energy Gas Storage Project is a solution to the growing gas storage crisis that is developing in the UK since the closing of Centigra's Rough facility, which provided 70% of the UK's gas storage. The brand new state-of-the-art fast cycle facility will provide a security of supply to the island of Ireland and the United Kingdom when fully developed. This project will allow natural gas to be stored in 8 underground silt caverns 1,500 metres below Larne Lough. Each cavern will have the capacity to store 50 million cubic metres of gas, providing a buffer against periods of high gas demand and volatility of gas supply, ensuring a security of supply. In 2012, planning permission was granted and the gas storage licence issued. Since then, many thousands of man-hours have been spent to ensure the facility is ahead of its time and future-proofed. There are 4 elements to this process. The well site, located adjacent to Larne Lough, the seawater intake and brine outfall, located at Castle Robin on the east coast, the leaching plant, located adjacent to Ballylumford Road, and the gas facilities located again adjacent to Ballylumford Power Station. At the well site, holes will be drilled using directional drilling technology to reach the silt strata, 1,500 metres below the surface. At the surface, the holes will be positioned 5 metres apart and capped with wellheads, situated in sunken cellars to ensure the highest level of safety. The holes are initially drilled vertically and then stepped out to provide safe distances between the caverns. Once the hole is formed, seawater is injected at high pressure, causing the silt to dissolve. As the silt is dissolved, a cavern is created. Each 85-metre diameter cavern is made in sections that take 3 months to complete. After 2 years, the cavern formation process will be complete and the cavern will have reached its full height of 180 metres. Seawater will be drawn in from a designated point 100 metres from the shoreline. Brine, a byproduct of the cavern formation process, will be processed here at the leaching plant prior to being discharged safely back to sea. Both seawater inlet and brine outlet locations have been very carefully considered to ensure minimum impact to the local environment. After the caverns have been formed, in order to inject and withdraw gas, a set injection and withdrawal facility is required. The facility comprises equipment to remove moisture from the natural gas recovered from the caverns and compression equipment to fill the caverns with gas from the network. With the equipment used, this will be able to switch between injection and withdrawal in under 90 minutes. The Island McGee Gas Storage Project is an exciting project, bringing the energy needs to the local community and also supporting the energy needs of Northern Ireland and beyond.
Forgive me for interrupting you, but I'm sure people want to know that Mrs May's vote was lost by 149 this time, so not quite such a big margin, but still pretty massive. So the next vote will be on whether we leave the EU without a deal. Okay, so all rather relevant to Northern Ireland. Who knows where it'll be a part of in the future.
So I hope you enjoyed the video. You can collect your PhD certificates after this. All of you can now build gas stores. This is a very quick artistic impression of the various parts of the gas storage facility. This is the injection and withdrawal site, which is effectively the gas plant. That's the leaching plant. That's the well site, where we'll have 7 bore wells. And that is the seawater intake and outfall. In terms of the company's future opportunities, let's talk a little bit about its current opportunity. We are building the gas storage facility in Northern Ireland. It will be done in 2 phases. Phase 1 consists of developing 2 caverns at a capex of £114 million. We will immediately thereafter proceed to phase 2, which is the leaching and the commercializing of caverns 3 to 7 at a total cost of £151 million. The estimated capex, as per the latest feed report that was issued in December last year, is a sum total of circa £265 million. The intention is, at the moment, InfraStrata owns 100% of the project. We clearly require equity financing at the project level to develop the facility. Once we are heading towards FID and take FID, we shall be reducing our equity interest within that project to bring to allow a new equity investor to participate in that project. We often get branded as a one-trick pony, which in reality we are at the moment, because our focus is clearly in developing this gas storage facility. Equally, we are conscious of the fact that we need to increase our shareholder value, we need to increase the exposure of the company, get involved in other projects. Therefore, we have set up the Island McGee Energy Hub Limited. This was set up on Christmas Eve, since we had nothing better to do at that point. We set up Island McGee Energy Hub Limited with the intention of incubating some key projects. Within the hub, we're looking at an additional 15 caverns that could potentially be developed within the existing salt strata. Key to the success of a larger portfolio of salt caverns is the twinning of the Scotland Northern Ireland pipeline, called the SNIP. At the moment, it has the capacity to accommodate the flows of 2 caverns, potentially 3 caverns. But if we start looking at projects of the size of 15 to 18 caverns plus, we will certainly need to develop a new pipeline, which is why we're looking at twinning the SNIP. During our discussions with the various offtake partners, one of the key drivers to the UK gas market has been clearly gas storage, but also the ability to bring in LNG cargoes. And one of the comments we have received is, can we build an FSRU? Within that discussion, we have now engaged with Costain to create an FSRU proposal to understand the economics and the technicals behind an FSRU. Along with the FSRU, clearly there is going to be boil-off of LNG and a whole host of other activities surrounding LNG. And we have an LNG combined heat and power project that we are looking at. Finally, we are futuristic, we are ambitious. Clearly there's a need to move away from hydrocarbons going forward. And one of our projects that we're looking at on a pilot basis is the introduction of hydrogen within the methane grid. A place like Island McGee in Northern Ireland, which is quite small, is an ideal place to test a grid that will have a combination of both natural gas and hydrogen. We have completed FEED. We are heading towards FID, final investment decision. The critical path to FID has got a whole bunch of activities that need to be completed. We intend on taking FID in the first half of this year. In order to achieve FID, we have some critical elements to go through. We recently completed a funding round in January of £1.5 million, which will enable us to buy the remaining land that is needed for the project. We issued an invitation to tender in December last year. We have received responses and the EPC contractors have sought clarifications from us. We expect to complete that process by the end of this month, early next month. We are a project of common interest, which basically means that we are eligible for EU grants. We have a grant structure in place already for the FEED study, a portion of which is due to come to us in the month of June, July. Further to that, we are applying for a works grant of nearly 40 million euros that will help us, if it comes through, to keep a substantial portion of the equity with us. To be perfectly clear, any EU funding is not considered in the economics of this project. If it does come through, it is pretty much the cherry on the cake. But all our assumptions, all our economics, all our discussions are predicated on the fact that we will not receive any EU funding. If it comes through, it's great. If it doesn't, the economics still work. In order to achieve FID, there are 4 critical components that need to be completed. We need to have an offtake contract in place. We need to have an equity partner. We need to have a debt provider. And we need to have an EPC contractor. All discussions are moving along in parallel and they're moving along very well. One of the questions we get asked time and time again is, why do we need gas storage in this country? Before I answer that question, let's look at what exactly is happening within the gas storage market. The UK has historically had one of the lowest levels of gas storage across Europe. In fact, we are the lowest gas storage capacities across Europe, while Europe has between 25 and 50% of its annual demand sitting in storage. We are down to 1%. We consume 100 billion cubic meters of gas every year within the UK. Our existing projects, our existing stores can contribute 1.5% of the annual demand. The huge game changer within the industry has been the closure of Centrica's Rough storage facility. It was the largest gas store in the UK, contributing 3.5 BCM of gas storage. That's disappeared. It's now being decommissioned as we speak. And we're left with 1.5% of annual demand sitting in storage. In terms of the planned projects that we are observing across the country, no other project has started FEED. You have a whole bunch of projects in the table below that have received planning permission. None of them have started FEED. Island McGee is the only project that has completed FEED, is heading towards FID. In terms of where we are relative to competition, we are probably 2.5 to 3 years ahead of the closest competition. We are not gas traders, although I'm from a trading background, so I would love to get back into the trading game, but we don't have a mandate to trade natural gas or to have a trading book. We tend to shadow gas traders. Our offtake clients are gas traders, trading houses, utilities, and we tend to understand, or we tend to follow their actions to understand what's happening in the market. The two main drivers for UK gas are demand and supply. UK gas demand, as we see it, is going to be fairly stable over the next 10 to 15 years. It is going to be underpinned by strong domestic demand, strong commercial demand, and also new build of CCGTs. So the way we look at it, the UK will continue to be a gas-led economy. There will be a place for renewables, there will be a place for solar and wind and other projects, but gas is going to lead the energy mix predominantly. The more interesting bit for us is what's happening on the supply side. The UK has historically produced its own gas with the UKCS. We used to be a net producer and exporter of natural gas. That has now declined dramatically to the extent that now we are a net importer of natural gas. Going forward, and the UK gas supply chart that you see on the right hand side has been published very kindly by National Grid. They issue their annual 10-year statement. So it makes a very interesting read. Going forward in the next 15 to 20 years, the UKCS is likely to supply only 10% of UK's gas demand. Where is the balance going to come from? We have the two interconnectors between Europe and the UK. We have an interconnector called Langelid between Norway and the UK. They have been flowing very well, and except for some problems on and off, we have had reliable supplies between Europe and the UK and Norway and the UK. We have two regasification terminals, actually three regas terminals, the Isle of Grain, the Dragon Terminal and South Hook. We have seen them highly underutilized over the past 4 or 5 years. We are now seeing an uptick in LNG cargoes coming into this country. The big surprise for us is the introduction of shale gas. National Grid predict that 30% of UK supply is going to come from shale. We have been following the shale market for the past few years. The total number of wells drilled are effectively 2, of which only 1 is flowing. How are we going to get to 30% of UK supply through shale is a question mark.
I want to leave time for questions, so if you can just bring it to a conclusion.
Essentially the point that we are trying to make here is that we are dependent on imported gas. 90% of our supply will come from imported gas. If there is a failure in the infrastructure, if the LNG does not turn up on a high demand day, such as today, or such as what happened in January, we run the risk of not having sufficient gas in the economy. The only answer to that is domestic storage, and that's where we come into play. We are based in Northern Ireland. The key market for us is Northern Ireland, but the bigger beast for us is the UK. In order to integrate ourselves with the mainland UK economy and the domestic demand in the UK, we are going to be using the interconnector between Scotland and Northern Ireland. At the moment, that is unidirectional. As soon as we take FID, the pipeline operator, Mutual Energy, have also committed to take FID to reverse the flow, which effectively means that we will be able to flow gas back from Northern Ireland into the UK. Now, why is this important? For a couple of reasons. One, we are able to increase the capacity of our gas storage facility, but more importantly, the trading houses that we are dealing with, who are our offtake clients, have got a significant exposure to the UK market and to Europe. For them to have physical molecules of gas flowing into the UK is extremely important. It adds optionality. It gives us better pricing. In terms of our cash flows, it's a very typical project cash flow that you can see. We spent the first few years building the project. developing the salt caverns. Phase 1 is for the first 3 years. Thereafter, phase 2 kicks in, which gives us a very healthy, consistent cash flow. The OPEX for these kinds of facilities are quite low, and we expect to see consistent cash flows year on year. In terms of the FID, the jigsaw to FID, as I've explained before, consists of 4 elements: the EPC contract, the offtake contract, the equity provider, and the debt provider. All 4 discussions are running in parallel, and they're progressing well. In terms of some high-level numbers, the equity IRR that's projected is about 21%. Depending upon what discount rate one would take, our NPV sits at between 141 and 2 million pounds. This kind of a project is ideal for a long-term investor, a pension fund, and infrastructure fund that likes consistent cash flows. We're looking at undiscounted free cash flow of nearly $1.6 billion.
You're going to have to go to questions now, if that's all right.
Just the last slide, and then I'm done. In summary, we are looking at a gas market that is increasingly volatile. FEED is now completed. We are heading towards FID. As of this morning, we have independent third-party confirmation that our economics stack up. This is a commercially and economically viable project. We are in advanced discussions with our funding partners. This project is a project that will have a 40-year life, so we can expect consistent cash flows year on year. We are looking at a whole bunch of other projects, as we've discussed. And finally, we are an AIM-listed company. The ultimate beneficiaries of this business are the shareholders, and that's what we aim to achieve in terms of increasing shareholder value.
Thanks, Arun.
Thank you very much.
That's great. Sorry to rush you at the end, but
No
obviously
problem.
you've got a lot of information to give us. So what do people want to ask about this project? Obviously a little different from the last 2, and but you can't move it to the UK mainland as well, but the interconnector aspect sounds very interesting. Question here.
Just on the salt cavern, I'm just interested to know how you make sure that it's 85 meters diameter all the way down. How do you do that? It's 180 meters high.
It's 180 meters high and 85 meters in diameter.
How do you maintain the diameter?
And that is controlled by the leaching process. So essentially what we end up doing is we take the drill downhole, we start leaching, which then effectively means that the salt is dissolved, and then we have a controlled environment in which we are able to determine the size, the diameter, and the height of the stone. Now, to be completely fair with you, I'm a commercial person, so this is very limited knowledge that I have, but there are methods in which we can control the process of the salt cavern formation. Just to be clear, salt caverns have been in existence for the last 45 years. It's not a new technology that we have developed.
No, they do it a lot in Europe, don't they?
Yes,
in
absolutely.
Germany and France,
yeah, it's very popular in Germany, in Austria, and in France, and across the United States as well. So it is not unknown technology. It's very well proven. Where we have a slight edge over the competition is in terms of the above ground installations, where we are putting in brand new compressors, high-tech compressors, a very sophisticated control room that will enable us to utilize this plant quite effectively.
Any other questions? One over there, just in the back.
Can you give us an idea of what the total capital cost of the project will be and the split between debt and equity?
Phase 1 is projected at £114 million, which is the first 2 caverns. Phase 2 is £151 million, which is caverns 3 to 7. So in all, we're looking at a capex spend of about £265 million. The economics that we have built into the models are 35% equity and 65% debt, or call it 40-60. That's the kind of equity debt split that we are talking about, and we are discussing with our equity and debt partners.
Any more for any more? Just one here.
Mic on, please. I'm Donald Leggett, Head of Investor Relations. What can you tell us about the the state of play with the debt discussions and the equity discussions?
I think they are progressing very well. We now have a couple of term sheets from equity providers. We have term sheets from banks who are looking at coming together as a consortium to fund the debt side of the project. Clearly, we need to still jump through a few hoops before we can firm up and finalize on both the equity and the debt financing. The intention is to take FID by the end of June, early July, and the indications are we should be able to do it given the nature of the advanced state of negotiations with both equity and debt providers.
And one final question here.
Umberto Nespolo with IO Oil and Gas. What's the typical cycle you're envisaging for the economics for your model?
In terms of the cycle that we are looking at building into the project, phase 1 will have a 30-day cycle, 30 days in, 30 days out. Phase 2, when we have the larger store, will have a 45 to 50-day cycle. So worst case scenario, 50 days in, 50 days out. What we are also trying to achieve over the next couple of months is to create some value engineering with our above ground installation partners like Costain, where we should be able to reduce that cycling time to 40 to 45 days. Clearly, the faster we will cycle, the more value we generate.
Thank you very much, Arun.
Thank you.
Thank you. Well, last but not least, we're going to get an overview of the oil and gas industry and hear from somebody who's worked in it for a good many years, both as a consultant and analyst. He's worked for Canaccord Genuity. He was head of UK oil and gas at Natixis, Seymour Pierce, Charles Stanley, Rockhopper and others. He is Richard Slape.
Good evening, everybody. Does that make that work? There we go. I haven't got very many slides for you, so we'll probably make up a little bit of lost time here. I'm just going to spend 10 minutes just talking about some of the things that it might be worth you thinking about before you stick money into the small cap oil and gas E&P space. A quick disclaimer there, which I think tells you that I don't know what I'm talking about. And then just a couple of lines about me. I mean, Nigel's really introduced me already, but there's a few logos there from some of the companies I worked for. I spent 26 years working for various sort of stockbrokers and investment banks, principally as an equity analyst, but always looking at the small cap E&P space. And then in 2012, I joined Rockhopper as their business development manager, which I was doing for just under 2 years before I went on the board of Lansdowne Oil and Gas, who were with Providence Resources offshore Ireland, and in fact I think are going to be drilling a few wells this year. Latterly, Hopton Petroleum really is just my vehicle. I work now on a consultancy basis for a variety of financial institutions and oil and gas companies, doing data room trawls, financial modelling, research reports, all that sort of good stuff. So small cap oil and gas companies, what have I learned over the years? The sad reality is that certainly in the last sort of decade or so, there's been a lot more losers than winners. And the first chart you can see up there, text may be a little bit small, but that's the FTSE AIM All Share Oil and Gas Index. And you can see the sort of run up there in the early part of the 2000s, really starting, I think, in 2004. The oil price took off. We had our own sort of little version in the E&P space of the dot-com boom, and investors couldn't get money into the space fast enough. The collapse there is the oil price going down from sort of 150 to 30 in 2008 before we had a recovery. But really in the last 10 years, it's been a pretty dismal place to invest. By contrast, if you'd invested in the larger stocks, the chart below is the FTSE All Share oil and gas producers index, obviously dominated by BP and Shell. Actually, if you'd invested in them, you've kind of done okay. Probably not quite as well as the market since the sort of since 2002-03, which was the sort of low point on the chart there, but not far off. So, frankly, that's been the place to have your money in the oil and gas space if you look at it on a long-term basis. Now, look, that's not to say there haven't been some spectacular successes in the E&P space. Plainly there have. But for many investors, all those gains will have been, wiped out and, perhaps several times over by the even larger group of equally spectacular failures. And I think one of the things you perhaps need to do in this space is, before you start trying to pick winners, is try and work out, the ones which are genuinely high risk. And, if you put your money into them, you may well end up with nothing in fairly short order. And, whilst that may result in you, missing out on a few spectacular gains, I think it'll save you money because you will miss out on even more spectacular losses. And I think, you need to ask yourself, how much of your portfolio and how much money do you want to invest in a company which is potentially focused on, just one or two licenses, exploration licenses, and with no reserves and production. And the reality is they make up the bulk of, certainly the small cap E&P space in the UK these days. I was looking at a chart the other day of on FactSet. They identify 78 UK E&P companies. Only a dozen of them have got market capitalisations greater than £500 million. And the bulk of them are sub £100 million, and the biggest group by far was the sub £20 million group. So really it's a kind of a micro cap space. One of the big issues, I think, is that investors have a tendency to, well, they don't tend to price risk appropriately, and I don't think they're entirely to blame for that. I think the industry has been, remiss in the way at times it's presented, particularly exploration plays, and the two big bugbears of mine is one, we're always being told what the P mean prospect size is. Well, frankly, we don't value P mean reserves. We value P50 reserves. So you want to know what the P50 number is, not what the P mean number is. And 9 times out of 10, the P mean number will be bigger than the P50 number. And that's particularly true, I think, in some of these very exciting but high risk plays where the upper end of the potential reserve size is not quite unconstrained, but can get very, very big, and that has a tendency to push that P mean number out to the right. I'm aware of situations in the past where the P mean has been around sort of P35, that sort of number. So quite a long way from P50. So I would always advise you, if you're presented with a P mean number, if you can, ask the company what the P50 number is. And I would tend to base any valuation that you might sort of come up with on the P50 number, not the P mean number. I think the other thing that you need to be aware of is chance of success. Almost always it's the geological chance of success which is quoted. Now, geological chance of success can be anywhere from literally P1 to the P99. The P99 number may not be commercial. You may have to come sort of quite a long way down the curve before you get to a resource number that's going to be economic. So what does that mean? Well, it means that commercial chance of success is, in all likelihood, significantly lower than the geological chance of success. So if you're sitting there valuing the prospect on the basis of the P mean and the commercial chance for success, I would contend that you are at the optimistic end of the spectrum before you've even started. So the chances of you being disappointed are higher than they should be. Management, I think, is absolutely critical when you're getting to know management is absolutely critical when you're investing in the E&P space. I would say that a lot of the E&P companies are a reflection of the personality of their CEO, and over the years, I think in the early days, Cairn Energy, for instance, was a reflected sort of Bill Gamble's personality. Thali obviously reflected Aidan Heavy's personality, and the list goes on. So, I think it's important that if you can, you meet management, you talk to them, you try and get to know them, and try and work out what it is that they're trying to achieve and how they want to go about doing it. And not everybody's trying to achieve the same thing. Some companies, some management teams want to build a business. They want to build a full cycle E&P company and be producing 100,000 barrels a day and paying dividends and all the rest of it. Others, very happy to try and work up a prospect or two, farm them out or not, or sell the business and exit much earlier in the E&P cycle. And it's important that you understand what it is they want to do, how they're trying to get there, and actually what's their time frame for doing it, and does that coincide with your own investment horizon? I think the other thing, if you get to, you should think about is go back, look at management's track record, and you will kind of work out that there are some management teams who tend to under-promise and over-deliver, and there are other management teams who have a tendency to be a bit more optimistic. They might over-promise and under-deliver. Now, all of that's fine, but you need to understand kind of where on the spectrum that management team sits. And I think, adjust your expectations accordingly. A lot of companies will tell you, a lot of CEOs will tell you, and I don't think this is something that just applies to the E&P industry. I suspect it applies to all industries. But CEOs, of course, always think their shares are too cheap, and they can't possibly issue any more stock because it would be too dilutive. And obviously, there's you don't want the company to be run by people who are just issuing stock constantly and not thinking about the consequences of doing that. But equity can be a currency. It can be a very useful currency for an E&P company. And let's not forget that the E&P business is capital intensive. So equity can be a really useful currency. And if you refuse to transact or do things because your shares are too cheap, your company won't stand still, it will go backwards. Because at the very least, you're just going to be burning your G&A every year. So I think it's really important that companies are willing to do, within reason, what it takes to keep their business moving forward. And I think the other great success story in the E&P space, I talked briefly about Cairn a minute ago. The other great success story in the E&P space over the last sort of 15 years, of course, has been Thali. And, to his credit, I think, in the early days, Aidan Heavy was always willing to do a deal and issue equity to get the deal done. And, let's be honest, had he not done the Arco deal, had he not done the Energy Africa deal, Thali would not be the business it is today, and investors would have missed out as a consequence. That's really, I think, the main points that I wanted to make. So, as I said, so we get through it quickly. 30 years condensed into about 10 minutes. But the sector has been a tough place to make a profit. So try and work out and avoid the losers rather than necessarily just sort of going out and trying to pick the winners from day one. None of us can see underground. The industry has a tendency, I hesitate to use the word misrepresent, but has a tendency to present risk in a way that may not give you the most likely, outcome. And, publicly at least, all CEOs think their shares are cheap, so, don't necessarily believe them when they say it.
Well, we can ask them, can't we? Thank you very much indeed, Richard. Very good. Well, we'll ask the panel in just a moment, but questions, thoughts about your own portfolios perhaps, or this sector? There's a question right here.
What are your thoughts on global RP ratios? If the numbers are to be believed, we should probably stop exploring.
Reserves to production ratios?
Correct. Yes.
Well, I think people are exploring less, right? That is the reality. A lot of the big companies, are leaving the North Sea, or they're leaving. They're giving up into their international businesses, and they're heading back to the US and investing in resource plays. So, RP ratios, for sure are quite high. I think the question is that at the moment that's sort of a little bit unanswered is that you've got obviously enormous resource in shale, but what's not clear to me is we kind of know that if you're operating in the North Sea, an RP ratio of about, you can probably live with an RP ratio of about 10, right? I don't know what the RP ratio is for those kind of resource plays, right? Because the resource is enormous. I'm not sure realistically, how much of that you could expect to produce in any one year. But look, this point well made, and I think actually, you can see the industry's response is there for everybody to see. They're not exploring in the way they were.
I saw some figures from the International Energy Agency. They estimate the world needs to invest $580 billion a year to keep oil and gas growing. 3 years ago, the investment was 350, and it's crept up. 370 2 years ago, 410 this year with a bit of luck. So yes, there is a lack of investment here, and clearly all these companies are battling to get a share of it. I'll ask you about your kind of where you feel your share price sort of perception is, but let's just get the question first.
I wonder if you've got a view of UK oil and gas.
No. Certainly not one that I would, talk about in a forum like this. I'm not going to answer questions about specific companies. I'll answer generic questions about the industry, but not about specific companies.
Have you got a view about the wheeled oil field that seems to have been discovered, and they've generated significant flow rates from the wholesale well?
I think the
that could be replicated elsewhere.
Yeah, I don't have a technical background. I do know a little bit about the Wheel Basin. In my view, it's quite an interesting play. I think that sort of hybrid. They call it sort of. I think Angus Energy likes to call it a hybrid play, and I can understand why, because it's a naturally fractured shale in effect. So you don't need to hydraulically fracture it, or at least that's a theory in order to produce it.
It's a conventional play.
Sorry?
It's a conventional play. There's no.
Well, you don't need to hydraulically fracture it because it's naturally fractured. Right. I think is the point. And there's certainly a view that it's laterally very extensive across the Wheel Basin. So look, we'll see. Obviously, Angus is having a few problems, I think, with Brockham at the minute. But I think it's really, really interesting. Yeah, the problem you always come back to onshore the UK, and particularly in the southeast, is going to be planning. Right? Nobody wants this stuff. Well, they want the oil, they want to drive their Range Rovers, but they don't want drilling rigs and trucks and all the rest of it in their backyard.
Except the local authorities are going to be getting big cuts from the revenue that's generated. So it's predicted about £1 million a well going to the local authurities.
All right. Well, thanks.
Well, not
very much
if you want to get re-elected, it may not be, right?
I'm sure you can continue this afterwards. There's a question here.
I was wondering if you had a view on the following. I find it interesting when I read the FT every day, and I read about university pension funds and sovereign wealth funds that are pulling money out of the oil and gas sector because it's no longer morally acceptable to invest in the sector. How do you think this is influencing the world of investors in this arena generally?
Well, I think the E&P space, in my view, is still not looked upon terribly favourably by the UK institutional investment community, and and added to that, I think these guys, one of the issues they're facing is that the specialists who used to sort of cornerstone a lot of this stuff just aren't there anymore. Either because they're investing in the resource plays that we just sort of talked about, or because actually they didn't do very well. They suffered in the downturn in sort of 2015, 2016, and they simply don't exist anymore. So I think it's certainly hard for small and mid-cap E&Ps, or harder for small and mid-cap E&Ps to raise money in the UK than it was at certain points in the past. Look, you're absolutely right. A lot of funds now are backing away from oil in particular. It doesn't necessarily apply actually to natural gas. I think there are some people out there who said we're not going to do oil, but we also do natural gas, which they see as a sort of cleaner, more environmentally acceptable fuel. What does it mean? Look, I suspect what it means is that more money will ultimately be invested by people in the Far East or India or wherever it is, who I suspect will have no such qualms about investing in the oil and gas sector, and they need energy. The global population goes up day by day, and I think it's very easy to sit here in the UK and look out your door and there's a Tesla and a Toyota Prius and think the end of oil's just around the corner. But frankly, most of the world's not going to have the luxury of buying those kinds of vehicles. They're going to be using fossil fuels for a long time to come, in my view.
Well, I was making that point at the beginning about John Hess saying that oil and gas will be a major part of the mix for at least 15 years, and that's got to come from somewhere. We're almost reaching the end of our time. I would like to just ask the panel to just comment briefly. I mean, Richard said all chiefs think their share prices are too low. You can comment on that if you wish. But it's also just being able to raise money in this environment that we've been talking about when there is scepticism around. Paul?
It's like anything. If you have a good project with good management, you will raise money. And the quality of the opportunity will still determine the market response. We raised $110 million in the summer of last year because I think we had a great project. At a time when we were told, the market wasn't receptive to oil and gas, and we were heavily oversubscribed. Also because it wasn't an exploration project, and I do think genuinely it is harder for explorers to raise money too. And the fact that we're converting investment to cash flow almost immediately, I think does make a difference. And the point about investment horizons and people's willingness to wait for exploration to turn into cash flow, I mean, that does make exploration, I think, more challenging in the marketplace. And so, that's difficult. But in the end, if you are looking to maximize hydrocarbon recovery, you do need all of those different aspects in order to do that. You've got to have exploration, and you've got to have efficient development and production.
Well, Jeremy's got plenty of exploration on his plate.
Well, yes, but we're not trying to finance it, and I wouldn't. I mean, investor sentiment is very negative on exploration at the moment. It's been negative on the whole sector for a while. There was a time when you wouldn't get past the words oil and gas before you were already seeing a sort of look of distaste and a slight curl of the lip. But now at least you can get to production and people are happy. But exploration is still very much no-no. And there are good reasons for it, because The thing about exploration is it's a very long cycle from exploration to cash. So how are you going to monetize the investment? Now, there was a time when there was a model for this, and it worked very well about 10 years ago. You farmed out, you got a carried interest, someone else was paying most of the way, and then you make a discovery, you don't, and then a big oil company comes along and buys your discovery. And that's the monetization point from the point of view of the investor. You don't have to wait all the way to the actual production, but that still takes quite a while, and it required a critical thing, which was it required people actually being there to buy those assets. So just at the moment, those people aren't really there, and that model broke down several years ago, and so far it's not fixed again. And as long as that's the case, I think that the investment case for pure exploration is very difficult. And that's why we've got some legacy assets, but the only real exploration we're planning to do in the near term is actually in the production license that we have, but it's still in the exploration phase. That allows us to do some low-risk exploration in places where the government want us to do it, and they're prepared to pay for it, because it'll be out of their cost recovery pool. Now, I don't think our situation is unique, and so I think there are other people in similar situations, other blocks, other countries where you can do this kind of thing, and so there will be exploration going on funded by that. And there'll be exploration going on funded by brave people. But at the end of the day, it's a very difficult sell right now to sell pure exploration. I think there's good reason for it. Once that model changes, if and when it does, then there'll be a new case for it.
So Arun, is storage an easier sell? You're going to need enough natural gas to store.
No, I think I quite agree with Paul's comment. For the right project and for the right management team, there is cash available in the market, but let's not kid ourselves, it's a hard slog. You can have the best project and the best management team, but it is a lot of hard work to raise monies.
Thank you very much indeed. Well, I think probably we'll bring our evening to an end, or at least the formal part of it. Thank you very much indeed, Richard, for giving us your thoughts at the end there. Lots of interesting themes seem to have come together. So thank you to Paul Blakeley from Jadestone Energy, Jeremy Asher from Tower Resources, and Arun for stepping in and doing the whole shooting match for InfraStrata. Please enjoy the refreshments, have a chat to anybody from LSE or our guests, and you'll be able to see the webcast in about 24 hours, and there'll be a link to that on the lse.co.uk website. Thank you very much, everybody. Thank you.